So, welcome everyone. Hopefully everyone's managed to get it logged on. We look as though we've got around 28 odd attendees at this stage, and hopefully that'll build, and it is building from what I can see. So, welcome to part one of our two-part webinar focusing on navigating the new rental rules that are in place for investors. Today's webinar is focused very much for Wakelin Property Advisory clients, clients that we've purchased investment properties for over the years, and clients that we're currently dealing with as well who are considering purchasing properties in the coming months. Today we're focusing more on the financial side of things, and I'm joined by two colleagues, Jarrod Telfer, who's our client liaison manager and looks after our VIP clients and manages the relationships between ourselves and the property managers that we utilise to look after our clients. And also Stuart Wemyss from ProSolution Private Clients, who many of you will be familiar with, who we conduct many webinars and forums alongside. So welcome, guys.
Thanks, Jarrod.
Thanks, Jarrod. Good to be with you. And sorry, gentlemen, I didn't get the memo that we needed to dye our hair grey for this presentation, but it's looking very good anyway.
Or just dye it black. So we've divided today's or the topic around the new rental rules into two topics. Today we're focusing more on the financial implications, and that's why we've got Stuart to help us out. And you'll have no doubt seen that we've got a second webinar Tuesday week or today week, focusing more on the practical side of things. And in that webinar, we'll be joined by a couple of colleagues from Nelson Alexander who help a lot of our clients in the inner northern suburbs. So what we thought we'd do is give you a bit of an overview of respective markets. So initially, I'll focus on the general property market just to give you a bit of an update as to how things have progressed through the times that we're in at the moment. Stuart will then give you a bit of an update on the financial side of things and what's happening from a banking perspective and how the market's progressing, the difficulties that people are facing. And then Jordan will give you a bit more of an overview on the property management side of things and more so the rental market and how that's been impacted by COVID-19. And then Jordan and I will start to ask Stuart a few questions around the direct impact for investors around how they can be supported from a financial perspective and what some of their options and what some of your options are to help cover off on things. So I'll get things underway, and I've got a bit of an overview here as to what I'll be focusing on in my section of the presentation. So a few of the developments within the market since February, or more so probably March, when the COVID-19 started to kick into play. There's been some discussions around whether or not from an investor's point of view there might be, or even owner-occupiers, whether there might be some changes to buyers' tastes and different expectations within the market. So I'll cover off on that. Properties that have been least impacted, those that have been more impacted, and then a bit of an outlook going forward as to what's likely to happen to the market in the coming months. So first of all, the changes, well, they've been fairly significant, and obviously that's been particularly around the supply side of things, but also the buying side. So there's been a lot of talk around has there been reductions in values, but because we've seen a pullback in supply and also a pullback in demand, it's probably balanced each other out quite well at this point in time. So we haven't seen a significant reduction in values. And that's obviously led to a reduction in transactions occurring. And a number of the major agencies in and around Melbourne have reported significant reductions. April was always going to be a fairly interesting month because even without the coronavirus, it was going to be impacted by school holidays and Easter and those sorts of things. So there's always a reduction when we have a late Easter in transactions that occur. That was taken to the next level, obviously, with the climate that we're in. But we've now moved, obviously, into May, and May typically would be a bit more of a thriving month from a transaction perspective because you find that there's a lot of campaigns that commence in the back half of April, and vendors wanting to sell before we get into the winter months where transactions do typically drop off again. So May has noticeably seen some fairly significant reductions in value over that period of time. So, but during the campaign, it's been interesting. Or during the downtimes, it's been really interesting, and we've seen a real mix of properties selling really well, and then others where it's been a real battle. So there's been a property that was looking to sell at the back end of March. Really nice property. I thought expectations were quite reasonable at the time. It's still sitting there, unfortunately, at the moment. Really nice townhouse that should have met with really good interest. And unfortunately, they've had price reductions, and that's come back probably 10% at least, and that's just been an unfortunate impact of timing. But on the flip side of that, there was a 2-bedroom apartment that sold in Carbrook Avenue back in April, and that didn't start. The campaign didn't start until we were really impacted by COVID-19. And the agent reported within 2 days of the property going online, they had 4 or 5 interested parties. They ended up putting an expression of interest date and having everyone submit offers by a certain period of time. They had 4 buyers put forward offers, and the property ended up selling for $20,000 or $30,000 above the 5 to 550 quote range. And the 5 to 550 quote range wasn't out of the ordinary either. It wasn't as though it was a light quote. So we're certainly seeing that there is activity around for the right properties and for properties where buyers certainly see that there is an attractiveness to the price point. So, which probably leads me a little bit to what I mentioned before, this asset taste changes. And there's been a lot of discussion around, well, with what's occurring and with the flexibility around employment and the changes to lifestyle, will there likely to be greater interest in property purchasing in suburbs further out and looking at buyers perhaps considering buying larger family homes? And is that market going to really take a next level? Perhaps even in regional areas, perhaps down on either of the peninsulas from a Melbourne perspective, or in cities like Ballarat, Bendigo, those sorts of locations. And I think that there'll certainly be some changes to our lifestyle going forward out of this. There's no doubt about that. But it's not going to be a full 180 and all of a sudden everyone's going to want to live externally from the city and it's going to change buyer demand overnight. There's still going to be, at some point, we are going to revert back to a fairly similar lifestyle to what we previously had. There will be a greater flexibility, but it's not going to be for everyone. So there'll be no doubt increases in demand in some of those regional areas, but I don't think it's going to be a drastic change. At some point, we are going to get back, unfortunately, to the congestion on roads, those sorts of things, and people are going to have to start fighting traffic again. So, and that's going to get frustrating. So you're not going to necessarily change everything overnight. And I'd caution people from thinking that, they're going to change their strategies around what they should and shouldn't buy. So that sort of then brings me to my next point around what are some of the properties that have been least impacted from what we've seen thus far? And this will continue to develop as time progresses over the coming weeks and months. But it's certainly been properties that have got multifaceted demand. So where you're not heavily reliant on one buyer profile. And I know we talk about that quite regularly, but this has certainly been indicated at the moment, where you're seeing larger family homes or development sites or properties where there's only a single type buyer profile that's being focused on. Those are the ones that are struggling, whereas those that have got multifaceted demand, so properties that suit downsizers, first home buyers, investors, people that might be looking for a town base if they are looking to retire or perhaps move further out, and low maintenance type lifestyles in good location areas with good access to amenities, public open space, which is really important at the moment, obviously, and public transport. Those are the properties that have they've certainly come back a little bit, as most properties have, but they've held reasonably firm and still meeting with good interest and are still having good competition at online auctions and also expressions of interest, that sort of thing. So those are the sorts of things that we're still seeing reasonably good interest. So next step being the outlook likely to be going forward. And obviously yesterday's announcements around from the Premier, specifically relating to property, around the fact that we will now, as of midnight tonight, be able to have open for inspections with 10 people in the property, but also auctions with 10 people in attendance, plus the agent and the vendor. So that's starting to ease us back into the property market starting to open up. And I don't expect that to lead to an avalanche of properties coming online and buyers and all of a sudden getting back to the norm. But it will allow perhaps vendors who really do need to sell, perhaps have bought something earlier in the year or are in a position where they really need to sell something sooner rather than later, to be able to conduct an auction if that's their preferred method of sale. But also perhaps some vendors who've been trying to sell in the current climate but haven't been able to generate that interest and feel as though an auction may be able to lead to that. that gives them that option to do that too. So it's starting to open up the market and led us to have those sorts of conditions and perhaps people wanting to get back online. So it's starting to get us back into the market that we've been preferring, or that would be an option for people. It's not back to normal, but it's certainly getting going down the right path, which is great, and that's what we'd be hoping for. So that's probably it from me around a property side of things. In terms of expectations around price, that's probably one only other thing, is that people have quite regularly asked about, has there been reductions in values? And as I said before, I don't feel as though it's really pulled back. The really testing time is going to come when we get to, and Stuart will probably elaborate a bit more on this, but around September, October, when the banks are going to start to expect people to be paying back loans. The government are going to probably start to pull back, depending on how things are going in terms of their support for businesses and things. And then people are going to be expected then to stand on their own 2 feet. So if that's going to put pressure on people, that's more likely when we're going to see an increase in supply, perhaps of vendors that really do need to sell, and there may be a bit more pressure involved. That's more likely when we'll see prices start to come back, and that will be the testing time. So we'll certainly be keeping a very close eye on that come August, September, October later this year. But I hand over to you, Stuart, if you can give us a bit of an overview on the finance side of things and what you're seeing.
Yeah, sure. Thanks, Jarrod. And certainly there's been a lot of movement in the finance industry from a banking perspective. And so I know this will surprise both of you, but you really just can't expect the very high level of service and quick turnaround times that the banks have led us to enjoy over the past few years. It's certainly changed a lot. You know, the really interesting number that came out recently from the ABS was that lending, particularly to homeowners, was up 17.5% on the year to March. So between March 19 and March 2020. So it's a pretty considerable uplift. Obviously, if we think back to March 2019, it was a backdrop of a federal election that had undertones of obviously major changes in negative gearing and so forth. So certainly lending volumes were coming off a lower base, but certainly lending had recovered considerably. Because there's obviously a large lead time, particularly in terms of applications being approved and settled and settlements and so forth, I expect lending numbers to be pretty strong in April and possibly even May. But really volumes will fall significantly from there. I mean, I think there'll be really significant falls in volumes, and that will have at least in the shorter term impacts on property market, because that goes to money supply. You know, what's the flow of new money into property, and that has an impact on demand and prices. But essentially, approval times and turnaround times across the board, across every institution, have really blown out to probably to an extent that I haven't seen before in the 18 years that since I established ProSolution. There's been two primary causes of that, apart from just complete disorganisation or general disorganisation within the banks. The first one is obviously they've implemented a lot of changes and announced a lot of changes as a result of responding to COVID. So that's the repayment pauses and these sorts of mechanisms. So they've had to divert resources to dealing with those changes. And as you can imagine, someone or a customer that requests a repayment pause is probably keen to hear from their bank sooner rather than later. So there's not really an appetite for people or an opportunity for the banks to, sort of deal with that workflow over a period of time. So there's been a big influx of high demand work. And then also banks across the board, again, have offshored a lot of their back office work, whether that's to the Philippines or India or so forth. But because of lockdowns, and particularly pretty stringent lockdowns in the Philippines, that's essentially no longer available to the banks. So they've almost on the fly had to kind of re-engineer their workflow, and that workflow then has come back to the people that work in Australia, most of which are also working from home. So, that kind of paints a picture of a very difficult sort of back office process, and it's really blown out. So It can take, it would have taken maybe a week to get a pre-approval in the past. You'd be looking at somewhere between 3 and 6 weeks. I know that's a big range, but it really depends on, a bank can be a 3-week turnaround time today, and then tomorrow it's blown out to 6 weeks. It's very unpredictable, which makes it very difficult to manage expectations. But everyone is obviously doing their best from a banking perspective, and they're all working under very unique situations. From a credit approval perspective, if you are working in an industry that has been directly impacted by COVID and the lockdowns, you're almost certainly going to struggle to get any kind of finance approved. And so those industries are obvious. If it's airlines, retail, hospitality, tourism, the sectors that have been directly impacted by the lockdowns. So the smaller fringe lenders have just said, no, we're not interested. The larger lenders have said, yes, we'll consider it, but we won't include all their income or maybe none of their income. So if one spouse is working in retail, for example, and the other spouse is working in a sector that hasn't been impacted by COVID, then they'll really just rely on that other spouse's income or the one spouse's income. I think that policy will persist until the banks can really ascertain what the longer term impacts and the turnaround, the likely turnaround from an economic perspective once things start to open up again. Another factor that's been impacted that contributes to the delay are bank valuations. As you can imagine, if you want to go and revalue an investment property that you own that has a tenant in it, a tenant's not necessarily going to be very comfortable with the value of walking through the property. So getting access to properties to do a full valuation has been really difficult and has caused naturally delays. So most of the banks are either doing one of two things: a desktop valuation, which really means that they look at the statistics of comparable sales, or a curbside valuation, which means they'll drive past the property and see the surrounding areas and aspect and so forth, but won't necessarily walk through the property. That has its pros and cons, and with both Jarrod and Gordon having a valuation background, I'll leave it to them to make some comments, but I think that's going to suit some properties but not others. We haven't actually had or experienced problems with valuations, and when I say problems, that is they're coming below expectation yet, but that's probably because the valuers are relying on data from really March and prior, and the 6 months prior to that, which is probably quite helpful data. But if we fast forward and do a valuation in September, for example, then we're looking at data really throughout the full shutdown period. And I hesitate to guess that, or I don't hesitate to guess that that's not necessarily going to be very helpful. Some of the banks have changed the amount that they will lend to borrowers. So Bank of Melbourne, which is St George Bank of Melbourne, owned by Westpac, has announced yesterday, in fact, that they will limit the amount they'll lend to self-employed persons to only 80%. So no borrowing above 80% for self-employed persons, irrespective of industry. Westpac itself it used to lend above 80% without mortgage insurance to certain industry sectors. It's pulled back those loan-to-value ratios about 5%. And those two changes have only occurred in the last week. So, all the banks tend to move in unison. So I guess the banks are worried about what potential falls in values we might see, and they're kind of protecting their mortgage book in relation to that. If you have a investment property that has been on a short-term let basis, so Airbnb and those sorts of things, banks won't include that income anymore. It'll be very interesting to see what their longer-term approach to that is. Obviously, at the moment, that's understandable. But given the impact of COVID on those types of properties, I wonder what their approach will be in the future. Every applicant must answer at some point during the application process what they refer to as COVID questions, which are really go to a couple of questions around have you experienced any financial hardship or a change in financial circumstances as a result of COVID, and has that impacted your ability in order to service and repay loans? And so you'll need to answer those questions typically at the beginning of the application process, but we have heard, and we have an experience with our client base, so we don't know if it's only really for some fringe lenders, but we have heard those questions being asked even leading up until settlement, and the bank not willing to settle unless they have confirmation that nothing's changed with a person's circumstances, which gives rise, I think, to some risk, but also makes sure it's important to deal with lenders that are going to be a bit more rational, I think, with respect to these things. The banks have had to change the way that, for the better, hopefully, the way that they deal with some things. So IDing, which you normally have to go into a branch to ID yourself for a bank, they'll now use an app. They're now emailing loan documents out to clients and having them signed electronically. So they've really jumped into, the current century. Something they arguably should have been doing for a while now. But hopefully those sorts of improvements start to really stick. In terms of interest rates, I guess choosing between fixed and variable is probably the easiest time to do that in history. And the reason I say that is that the RBA has said that they're not going to cut the cash rate anymore. It's at 0.25%. And that's where it will stay. Really, well, it won't go any lower. It's only up from here, but that's probably not going to rise for at least sort of 3-ish years. Most people's expectations are. And I can't see the banks cutting variable interest rates independent of the RBA either. Margins are already pretty thin, and there's enough pressure on bank profits. So I think we can safely assume we know what the floor is, in the interest rate floor for variable interest rates. And so the comparison between fixed and variable now is going to be relatively easy to do, given we probably know what the variable rate looks like, at least the minimum variable rate for the next 3 years. And when you compare that, compares pretty favourably to, say, 3-year fixed rate. So for owner occupiers, the fixed rate's about 0.6% lower over 3 years, so that could save you quite a considerable amount of money, and about 1% lower over 3 years for interest-only investment borrowers. So, if you've got an investment loan, potentially you can go and fix that investment loan and save 1%. That's not too shabby. Of course, you need to think about the pros and cons of fixing. You can't have an offset typically against a fixed rate product. You're restricted in terms of extra repayment, so certainly look into those factors, or at least consider those factors before jumping on it. But certainly fixed rates seem pretty attractive. I think policy, as a general comment in terms of lending and conscious of time, as a policy, I think policy will remain tight and probably tighten over the next few months. I think the banks are more concerned about what the economic impact to borrowers will be. As Jarrod alluded to, not during the period where there's some support, but when there's less government and banking support post-lockdown. And then I think the key risk globally and domestically is a second wave of infection, and therefore another lockdown, and that's going to obviously cause not only a lot of humanitarian problems but also economic ones. So I can imagine credit will be pretty tight for most of this calendar year, and then hopefully as we get towards the end of the calendar year and some of those risks subside, I think the banks will start to loosen up pretty considerably. And I think they'll be very, very keen, as they've been selling off their businesses in the wealth space and the insurance space. I think they'll be very, very keen to build their economic engine that's delivered most of the profit and cash flow over the last 30 years, which is residential lending. And I think they'll be very keen to sort of build on that book and build on that profitability. So I think they'll come back strongly, but it'll be pretty tight this year. So that's enough for the exciting finance stuff. Let me hand over to someone that was once described as the Charlie Sheen of the Melbourne property industry. Jordan, take us away. You're going to talk to us about the rental market.
I am, Stuart. I've just noticed my signal dropping away that little bit, and if you could let me know if you're having troubles, because if you're having troubles seeing or hearing me, then I'm sure others are too. And I'll see what I can do about it.
You're loud and clear, Jordan.
Good, Stuart. Good. So what I wanted to do is have a chat about the property management side of things and the rental market, because we've had, understandably, a number of clients of ours who, probably being a microcosm of the wider market out there, are concerned about the state of play. They've got particular issues that are that they're facing with either vacant properties at the moment and attempting to find a tenant, or being presented with requests for rent reductions and those sorts of things. So I just wanted to cover off on a little bit of those discussions without impinging too much on next week's webinar, which is going to go into a lot more detail. I thought a good launching off point, though, would be just to have a quick discussion around that. The last couple of weeks, the Emergency Measures Act, which was passed within the last fortnight by the state government, it's created some certainty for sure. There's been a lot of uncertainty over the last month with some thought bubbles around moratoriums on evictions and these sorts of things. At least this now gives us a lot clearer direction, and property managers representing their clients. So this Emergency Measures Act, it's basically an attempt to support the housing market. It's designed to complement, but in some cases supersede, the Residential Tenancies Act. The design of it, though, is it's time limited. So it's for specifically for issues COVID related, and kicking in from 29th of March with the idea that it then extinguishes, I suppose, 6 months later on the 29th of September to get us through those next 6 months. We'll see what happens, whether it's repealed earlier, whether it's modified, extended, who knows. But at this stage, that's what we're dealing with. The purpose, as I said, it's an attempt to support the housing market, not the property market, the housing market. So tenants, owners, landlords, that sort of thing. To provide protection from eviction for tenants, but also to put some mechanisms in place which allow for a negotiation to take place between landlords and tenants for rent reductions, with the goal that everybody shares in the pain. That's the stated intention of this. It's not all down to the landlords. It's not all to be absorbed by tenants. The result, though, understandably, from a lot of our clients and wider in the wider market, is that there's a great deal of concern for property investors. Tenants aren't the only ones that are impacted by what's going on out there. Landlords are as well. They might even themselves be in a worse position sometimes than tenants, insofar as their financial hardship is concerned. So with the thought that there could be mechanisms in place that allow for a totally renegotiated lease whilst the fixed term is still running, and the prospect that the expected income isn't going to be paid in full to then help obviously defray mortgage costs, it's understandably a point of concern. So those measures, there's probably three main measures that have come out of this, which most people are probably aware of now. And that's that under this Emergency Measures Act, for the next few months, notices to vacate can no longer be issued, certainly for rental hardship brought on by the coronavirus situation. There's always exceptions to that: malicious damage, criminal activity, these sorts of things, and even a willful non-payment of rent is also outside of that. So if a tenant simply refuses to pay rent, if they go on a rent strike, if their position is regarded as, well, they're not in financial hardship, but they're refusing to pay rent, well, that is grounds for a notice to vacate. Usual avenues have to be followed through VCAT, but those are some exceptions. But pretty broadly, though, no notices to vacate. There's a freezing on that. No rent increases for the period of time which this new act covers. A little bit of a moot point, as I'll get to in a few minutes, in that this isn't the environment where rent increases can be expected. I think if you can maintain your rent rolling over onto a new lease, you've done particularly well. So it's probably a bit of a moot point, but still that's a stipulation: no rent increases. And no listing of a tenant on a residential tenancy database, which is understandable and quite reasonable. So no blacklisting, so to speak, of a tenant if they fall into financial hardship and can't pay their rent in full. So there's the flip side of that, or a corollary of that, is that there are some financial support measures that have been put in place, which has obviously gained a fair bit of media attention, understandably so, in the last week or two. Land tax deduction and deferral of payment is an avenue for a landlord to get some relief. We'll talk a bit more about that. Certainly, Stuart, we'll come back to Stuart on that fairly soon, and we'll also go into that as to whether or not it's a real benefit or not to residential landlords in particular. But the main one that's probably going to offer the major relief is the rent relief fund, and up to $2,000 can be paid. It's applied for by the tenant, but gets paid directly to the landlord or their representative, so their property manager. That again is a whole new can of worms, which we'll get to at some point, more likely next Tuesday. But that is a form of relief that is genuine and would certainly help to defray at least some portion of a rent reduction that's negotiated with and agreed with the tenant. So where to from here? Say for a landlord that's received that request for a rent reduction from their tenant due to hardship. Well, as you'd expect, there's no one size fits all. There's some, from the experience of a number of our clients, there've been those that have tenants that are just looking for a month or two of relief and at a small reduction, and then have even turned around and offered to repay that rent through higher rent payments when they're back on their feet, which is wonderful of them. The other extent are people that are in such a situation they say, I can't pay any rent, and then there's all points in between. So there's no one size fits all way to approach it. But also each landlord will have a different threshold in terms of what they can cope with in terms of rental reduction. My advice though for our clients is, before you do anything, either before agreeing to a rent reduction or outright rejecting it or finding some sort of middle ground with a tenant, is to actually determine what your own financial position is first. Having established that, you can then work out where that threshold is and where that point is reached in a rent reduction before it really starts to hurt, and where you're taking on as a landlord more of the pain than what should be expected. I think there's probably three areas that need to be explored. First of all, consult your landlord insurance policy or speak to your broker. Most landlords would have that and a fairly comprehensive coverage there. Work out what the entitlements are under that policy, what your obligations are. Most comprehensive policies should have a rent default element to it. Now, does that still apply? Probably not, but it's worth the question, and it's also well worth determining what, if any, impact on your policy will come about if you enter into a rent reduction negotiation or rent reduction with your tenant. Will that impact the benefits that you would ordinarily be expected to have from that policy? So I think it's probably a good first port of call. The second is to speak to somebody like Stuart, your broker, your bank, just to see what support measures are in place, some of which Stuart's covered. We'll delve back into that in a little bit more detail shortly. So issues around deferral of mortgage payments, the impacts on that though, they're not. It's not a mortgage repayment holiday, so to speak. There's that interest will be expected to be paid back at some point. But what are those impacts? Perhaps a temporary move to interest only, if available. Fixing at a lower interest rate. Again, these are issues that Stuart is far more qualified to comment on and has touched on so far, but these are some of the things which you can at least speak to your bank about. And then finally, probably most importantly, is determine the extent of the benefit that is available to you as a landlord. So those two elements, the land tax reduction up to 25%, and the rent relief, a $2,000 rent relief grant that can be indirectly gathered. So again, we'll cover off in more detail in that next week, and some strategies around that, ways to approach through your property manager, ways to approach the tenant, try to come up with something that suits both parties. So finally, I suppose, well, what are we seeing in terms of the state of the rental market at the moment? I'm pretty much on a daily basis talking to a lot of our property managers that look after our clients' properties around Melbourne, and they're all coming back with the same sort of story. Now, I'd say that there's no definitive uniform effect right across the market, right across all areas, and right across all types of property. We're seeing some of our clients who have been in the unfortunate position of having their property fall vacant in recent weeks and then back into the market looking for a tenant, have actually not suffered too much of a rent reduction at all. $20, $30 a week on properties worth $750 a week, which, look, it's $1,000 a year, but in the greater scheme of things, it's probably not too bad. I've had a number of property managers, though, tell me quite independently that anywhere from $100 to $120 a week reduction, excuse me, from the most recent lease to that which is signed now is not uncommon. And those are on houses in that $600 to $700 a week bracket, which is a significant amount of money, 10 to 20% drop. And that's I'm hearing that from a couple of different agents property managers throughout Melbourne. Another senior manager I spoke to on Friday, she indicated that this time of year they'd normally be expecting to deal with about 70 properties that are vacant and that they're trying to fill for their landlord clients. In the last couple of weeks, that's increased to about 120, which is a significant increase again for this time of year. It's creating a lot of work, extra work for property managers in a difficult environment, and a lot of stress, understandably, on landlords watching their properties week after week fall vacant. Now, that blowout is caused by really a double hit to supply and demand, as from what I can gather. On the demand side of things, and particularly talking to the property manager that I referenced there last week, they're in a market where there's a number of apartments, and a lot of entry-level apartments, if you like, as well. The hospitality sector, which is where you would normally expect tenants to earn their income from, that's been hit. We all know that. That was the first one hit. Job losses have been felt there more than just about anywhere. That has resulted in tenants who would ordinarily, 3 or 4 months ago, be able to afford what would be considered a fair market rent, not being able to get anywhere near that. So that's hurt things. Probably on the more of the periphery, international student numbers have dropped away, again, fallen off a cliff with no international travel allowable. Now, for most people probably attending here this afternoon, that's not an issue. We don't tend to buy that property for our clients, and I'm sure very few people have that sort of property. But this sort of thing is creating ripple effects throughout, particularly the apartment market. And then there's the supply issue in Airbnb apartments. Again, same reasons. No tourists. Or very few tourists, certainly international, but domestically as well, has now shifted a lot of those owners back, shifting their properties back into the conventional rental market, which is adding to the supply, and which is causing these numbers to increase. So, and as I said, this is one sector of the market, but those ripple effects are being felt, and they've been felt pretty immediately because of that, because of those factors. We would like to think that once the ship rights itself and things return to some form of normalcy, that those reductions can then be turned around pretty quickly, and the next lot of rent negotiations or leases can start to get back to what we would have considered more normal, a more normal level from just a few months ago. We'll wait and see how long that will take. Well, we don't know, but it's going to be dependent upon life as we knew it returning to, again, some form of normality. But again, we'll delve into some of that a little bit more detail next week. So finally, though, and again, what we'll discuss in a bit more detail, ways to navigate this. There are ways through it, and some of these things that we're considering and suggesting to our clients. Consider short-term leases. So particularly at this time of year, instead of the normal 12-month lease, perhaps look to a 6-month. It's very appealing to a lot of tenants, prospective tenants, because their situation is uncertain. They like the idea of a 6-month lease in a lot of events. We do that, we get the property into the end of the year, and that tenant, if their situation stabilises, if the wider economy stabilises, they might then look to get things onto a 12-month lease if they leave, or at least we're into a better time of year, traditional time of year, January through March, which tends to be the stronger time of year as a property owner to find a tenant. So that's an option. Might be unpalatable, but if the finances allow, bring forward refurbishments that you might have been thinking about 2 or 3 years down the line. Do that now. Take advantage if there's some downtime with the tenancy, and you'll also allow your property to stand out from the crowd in what is, as I said, an increasingly crowded market. Little things could also help. If you can't extend to a refurbishment, an installation of a split system air conditioner, for instance. New laws that have now been delayed, who are expected to come in as of the new financial year, require heating in every property. So get on the front foot, install a split system. So these are some of these little measures that can be taken to alleviate the current situation, try to maximise the rent that you can get and minimise the downtime. So I hope that was a reasonable explanation of where we see things at the moment. I'll hand back, Jarrod, and we'll fire some questions at our financier.
Very good. Thanks, Jordan, and thanks, Stuart. That's given a very comprehensive overview of both states of market. So now moving towards, I guess, a bit of one of the main gist of what we wanted to talk about today was the financial impact and how we can navigate through that from a financial perspective, and certainly where you have been directly impacted. So I guess, Stuart, first of all, have you had many of your clients over the last month or two that have come to you with these sorts of requests, and what are some of the options that you've given to them?
Yeah, I guess initially when the banks announced that they'd be allowing people to put their loan on pause if they've been impacted by COVID, I think there was a bit of misunderstanding initially that people were thinking it was kind of an interest-free period, that you didn't have to not only make the repayments, but you weren't incurring the interest as well. So obviously that stimulated a lot of interest. And I reckon we probably fielded about 100 emails from clients in that first week. And look, I think a lot of them probably didn't pursue the option when they learned that they still had to pay the bank interest, unfortunately. But since then, very little demand. But the Australian Bankers Association released figures on Friday that said there was 643,000 loans that have been placed on pause. 61% of them are owner-occupied loans. Okay. And they amount to about $200 billion. So I suspect from the conversations we've been having that a large proportion of those that have been placed on pause has been the result of a very, proactive response to potential risks rather than actual risks. So I think a lot of people thought, well, I'm going to take this opportunity so that I can preserve my cash flow in a situation where they may not really need to have done so. That is, that their situation hasn't really been impacted, but they just like the thought of holding more cash flow. And I think what it does do is reiterate to us, and something that we always speak to our clients about, maintaining strong cash flow buffers. At least, I typically like my clients to have at least 6 months worth of living expenses just in cash savings. And then we always build in buffers into investment loans and these sorts of things, so that you don't need to worry or be too concerned about these sorts of things. If your cash flow hasn't changed and if it does change, it's okay. I can call upon a very large amount of cash to get myself through, the next 6 to 12 months. You're not necessarily going to jump at these things. So good question. I think it's been quite popular But I question if it's been misused by a lot of Australians in that, in the fact that they've done it where they don't really need to do it.
Is it a difficult process though?
No, it's not. And clients can do it directly with the bank. In fact, so brokers haven't been involved. They've all got a specific sort of COVID page on their website. You put all your details in there, they answer a few questions, and it's done. Someone might call you just to kind of explain the process and obviously particularly clarify, you're still going to incur interest, that the interest will be added to the loan, that the loan repayments might be higher at the end of the pause process, etc. So people understand the pros and cons of doing it. But the chances, the likelihood of getting it approved, no problem.
Yeah.
We haven't had any feedback about any pushback. And I think the banks are kind of very compliant, surprisingly compliant. Maybe they've learned some lessons through the Royal Commission in terms of really helping borrowers through this period of time. So I actually think it's been a good opportunity for the banks to start rebuilding them. They're nowhere near rebuilt their trust, but go towards rebuilding their trust.
So it doesn't really matter then, Stuart, whether or not you're applying because your own employment situation has altered, or whether or not your tenant has applied for a rent reduction.
No, they'll ask the question, have you been impacted, and to what extent have you been impacted? But irrespective of your answer, I think most banks, certainly the larger banks, are going to be very open to providing it. And really, it's just a cash flow impact for the bank. It's just a delay in cash flow. They're no worse off. Obviously, there's a greater risk of default at the end of the day. If you end up owing a whole bunch of money and there's not enough equity in the property, et cetera. But arrears and default rates in Australia have been persistently low for 4 or 5 decades. Like I suspect they'll rise, but not materially so. So I don't think it's a big deal for the banks, really.
What sort of timeframes? Are they 6 months, or are banks looking at it 2 or 3 months at a time?
Most of the banks are 6. NAB is 3 with a review after that, which is kind of interesting, which probably typical NAB fashion make it a lot harder than what it needs to be, because they've caused themselves extra work at the 3-month interval. I would say to people, if you need it, certainly use it. But if you're just doing it because you're worried about things occurring, don't do it until those risks or those fears actually eventuate. I think the capacity to be able to put your loans on pause will be there for at least the next 3 to 6 months. No questions asked as well. So I think it's always going to be there as an option. So it's not something you need to lock in now unless you really need to do it. And I would have just as you counselled people, Jordan, in regards to understanding your own financial position with respect to rent reductions, the same thing would be with respect to loan repayments as well. If you think it's only a 3-month, a short month period, that's all you need, go for that. And again, if you need to extend it, I'm sure the bank's going to be willing and able to comply.
So so the interest rates have been capitalised. Is that the idea, Stuart?
Yeah, that's right. So each month, the interest that you would have otherwise paid is added to the loan balance. A few of the banks have said quite kindly they're not going to charge interest on interest, because obviously as your loan balance increases, so should the monthly interest. For most banks, the interest will be based on the original loan amount, the loan amount that you started before you put it on pause, which is promising. And then so at the end of the period, depending on how you've structured your loan, whether it's interest only or principal interest, naturally your loan repayments will be higher at the end of it because your loan balance is increased. But at these kinds of interest rates, unless you've got several millions of dollars that you're putting on pause, it's the cash flow impacts are unlikely to be that material.
And you'd hope no impact on the credit rating, I presume, or? No,
they've been very kind at making sure that there's not going to be any impact whatsoever on the credit rating, which is in an environment where there's more positive credit data out there. So all the banks now are getting feeds from every institution, whether you've repaid your credit card on time, all those sorts of positive data, and that goes to your credit score. So the positive news is there's not going to be any impact on that as well. And nor should there be. I mean, they're there to allow people to deal with something that is not of their own doing, that is completely unexpected.
Yeah.
So I guess Jordan mentioned before about the support measures that are in place, and I guess the one that's probably most applicable to you, Stuart, is around, and we've had a few questions actually in the question box as well around the land tax. So first and foremost, there's discussions around the 25% discount if you qualify. Can you just expand on your thoughts around that and if how beneficial it's actually going to be?
Oh, I mean, I wonder if it's actually worth logging into the SRO website to submit your claim. That might be a bit silly, but really, I looked at it. I mean, if you had a property with a $750,000 land value component, your annual tax bill is about $1,700. If you're getting $550 a week, which you discount by 50% for 4 months, that's going to cost you about $5,000 or just under $5,000. And if you provide that saving to the tenant, the very generous Victorian Government is going to discount the land tax by $430. So about 9%, they'll wear about 9% of the reduction in your revenue. So, you know, whether you walk, I mean, it's better than a kick in the pants and nothing. It's fine. Great, of course, log on and submit your claim. Which all you need to do is actually log on, submit your claim. You've got to provide the existing rental agreement and then the new agreement that you have with your tenant to demonstrate that you provide that rent reduction. And as long as the value of that rent reduction is more than the 25% of your land tax bill this year, which you either paid in full in January or you're paying over instalments this year, either way, that's all you need to do is log on and provide that. Whether it's going to change people's worlds, I highly doubt it. Yeah.
Yeah.
Very good. Well, that probably concludes the main part of the webinar, but we've certainly had a couple of questions submitted before as part of the registration process. And now I've noted there's been some great questions put in the chat box as well. So, Stuart, if you want to start with some of the asked questions, and then we can work through some of the ones that were asked during the formal part of the presentation.
Sure. There's one from David asked when he registered, but also I know Owen submitted a question that would have been presented. And both the questions go to the impact of people working from home and whether that will change, I guess, the level of demand either close to the city or further away from it. And I guess a good example, Jarrod, might be, say, more regional centres. So people wanting to live in Geelong, for example, if they can work from home 3 days a week and come into the city maybe 2 days a week or something along those lines, given that they've been almost indoctrinated to some degree to do that over the last few weeks, and it might be suiting their lifestyle. So do you think there'll be a shift in demand as a response to that?
I think we covered it to a certain extent in terms of changes in preferences in the main part or the tastes of property selection. I think that there might be a slight change for some people, but you've got to bear in mind that this is not going to be forever, the current conditions that we're in. So, and there's a lot more than just work balance. There's a lot of other things that take into account that people consider about their lifestyle. It's not just about their employment. So there's family, friends, where they're located. There's access to services around education for children, around medical facilities for those once you get to retirement age. That's certainly something that people bear in mind. So obviously there's still some very good facilities and services around regional areas, but I think it's going to be more focused around that. So you might look at Geelong, Ballarat, Bendigo, and some of the surrounding areas of those that may allow for it. But as I said earlier, the congestion is going to come back. And so people may be, if you're able to have some flexibility in employment, and I certainly think that's what's one of the main things that will come out of the current situation that we're in, is that people are going to understand that they don't necessarily need to travel as much, whether that's interstate, internationally, or even just domestically around the state itself, that we can get a lot done remotely. So there may well be a bit more demand, but I don't think work is going to be the sole reason that people are going to change their lifestyle elements. It may well be for some people, but I don't think it'll be across the board. And I certainly wouldn't be changing. I don't think it's going to have a drastic influence in terms of property values that will take people one way or the other. Jordan, I don't know if you want to expand on that any further.
Not really, Jarrod. No, I think you've covered it pretty clearly there and also earlier in the presentation. no, not on that particular question.
Stuart, there's been a bit of talk lately, and I guess we can have probably out during the My Say on this as well, but around the changes to land tax or potential changes to land tax around stamp duty. Have you got any thoughts around that at this point in time, around whether, well, A, whether it's likely, but B, the positive, negative impacts that may have?
An economist made a comment, and I apologise because I can't remember who it was, but they weren't. They had a relatively high profile. An economist made a comment that he thought the best tax reform was to actually get rid of physical money, have everyone use an electronic system, and levy a tax, an electronic tax on transactions. So kind of like a GST, if you like, but more of a consumption tax, and that would replace really everything. And obviously, you know, if you go to a supermarket or any sort of vendor at the moment, they would prefer you to pay via PayPass than with cash. So we're all kind of getting used to it. So it's not as far-fetched a suggestion that what it might have been maybe 10 or 15 years ago. And I think a consumption-based tax is a lot fairer. And it also closes the loophole, which I mean the ATO has been very, very keen on doing for a long time, and has made headway into the black economy and the cash economy, and its drag on overall taxes. Of course, then the government, the state and territories have to agree with the federal government of what that looks like as well, and that there could, you know, that's politically can be challenging. If you think about stamp duty rates, I mean, they haven't changed for about 25 years, I think, in terms of scales, but obviously property values have changed considerably. So now from a dollar value perspective, it's not a very efficient tax. I mean, it creates a lot of problems in terms of people downsizing and moving, and creating accommodation, or at least supply of accommodation that's more commensurate with their needs at that particular stage of their life. So I think it has a lot of merit. Am I sitting here hanging my hat on things will be changed considerably? No, not really. One of the good things with stamp duty is it forces people to think very, very carefully about their property decisions, both in terms of selling and purchasing. And I don't think paying the stamp duty is worth that benefit, but it is good because it means people don't react with emotion as quick as they might do with other asset classes. You could, at the click of a button, you can go and sell some shares. And you may wake up, you know, a month later regretting that, of course. So there's pros and cons with both that. But I think it helps the level of volatility in the property market, that the transactional costs certainly help that. I don't know if you guys have any views on, you know, its impact.
I mean, well, I think in the immediate term, the immediate introduction of something along those lines, it would lead to a jump in values pretty quickly, because people will take that 5% that they've had to pay in stamp duty and just put it onto the purchase price of the asset. We've seen it with incentives before, particularly around first home buyer incentives that get offered. That's typically what happens. It just you take the money that's been given freely, so to speak, and just put it straight onto your purchase price. So I think that would certainly have an impact, particularly given that the land tax on an ongoing basis would be viewed more as just that's just a cost of holding, more like your rates and those sorts of things. So I think that would be an immediate impact. That's probably in terms of initial. Now, whether it actually goes ahead or not, I mean, we've heard so many different changes to property taxes and things over the years that have never been implemented. So there's a lot that would need to happen before this does. But it would certainly more than likely increase transactions as well, because as you said, Stuart, people do think about it when they're worried about having to pay that money. But it would certainly mean that people would be more likely to sell on a more regular basis, rather than what we've seen a lot in recent times is people, when they upgrade, have had second thoughts about upgrading properties. So it was quite common 20, 25 years ago for people to go from a single-fronted cottage, perhaps in an inner city area when they had children, move the 10Ks further out and buy the suburban home. People have been less likely to do that in recent times, and what they've focused more on is renovating the existing property in the inner city area and staying put. So because the cost of transacting real estate has been so expensive.
Yeah. And we might have time for one more question, Jarrod. And Romana's asked about what your expectations are for a V-shape property recovery. So if we do see some price depreciation this year for both of you, do you expect that to rebound relatively quickly, or what's your view on that?
I don't necessarily think it'll be a V. I think it's probably more of a U. I think we'll see a bit more of a downturn. I think it'll be flat for a period of time. I'm not expecting it to be all of a sudden we get out of here and we spring back up. I think it could recover quickly when it does, but I don't think that's going to happen overnight. Jordan,
I think that the one saving grace, I suppose, is coming into this is that the market was strong and it was improving and it was strengthening. If it was a year ago, it would have been probably in a sicker state, and it probably would have taken a lot longer to bounce along before seeing that increase. We've seen probably, I don't know about you, Jarrod, but I think that a lot of the transactions that have taken place over the last month or two, obviously people are already in the market and they're motivated and they've purchased what's available there. Now, again, I look back, say, a year ago, as we were sort of approaching that, what's regarded, I suppose, as the turning point of the market with a lag was the election.
Yep.
We saw it. It was very, very, from a selling point of view, the interest just wasn't there. So that will at least provide some sort of impetus. But I would imagine, though, by the time we get towards the end of the year, those that were already in the market will have been absorbed, and then it will be reliant upon new entrants coming into the market, whether or not the environment allows for that with unemployment, uncertainty, all those sorts of things. Time will tell.
I mean, you look at the slide that we put up there. I mean, it shows you exactly as Jordan said that 12 months ago, what the clearance rate was hovering around at a similar level. Obviously, there was a lot more auctions occurring, and that's why you've got to be a little bit guarded at the moment around taking too much notice of the clearance rate. I wouldn't be putting too much on that at the moment when there's a lack of transactions occurring. But it certainly shows you that 12 months ago, the market was very flat. And it didn't really start to pick up until August, September. And that's when we got that significant growth through the spring market and the clearance rate picked up, which is highly unusual. Usually you expect the clearance rate, even in a fairly strong market, as spring progresses, the clearance rate typically drops off as a lot of buyers exit. But there was so many people coming into the market last year, and there was a lot of pent-up demand, and there was expected to be a lot of supply coming through this year, because vendors had to wait 2.5 years where the market had been suppressed to really have the confidence to put their properties online. And they'd seen that through the spring last year, and the expectation was, and it was certainly coming to fruition, that they would do that through 2020, but that obviously got put to a halt. So there's still interest in people wanting to transact real estate. Now, obviously, their circumstances have changed, but once that confidence builds up again, I would expect it to improve. It's not going to be happening overnight, though, and there's still a lot to happen over the coming months. As Stuart mentioned before, if we were to have the second wave come through, that could shatter everything. So you would want to be putting too many expectations or forecasts out at the moment when things can change very quickly.
Yeah, they can change quickly, but as you said also, Jarrod, that you want that diversified level of demand. And certainly from my perspective, or at least my client-based perspective, I would say the vast majority of our clients have been relatively unaffected by COVID. And I would say that there's a strong proportion of them that will come out of it financially stronger, whether they've got the confidence, because confidence is another thing that's going to drive transactions. Whether they've got the confidence that, I have no idea, but or is yet to be seen. But from a financial perspective, and so notionally, as I explain it to clients, is if you have one property and you've got 20 potential purchases for that one property, maybe of those 20, just notionally, maybe some of those 20s will be impacted by COVID, will be put off, will be too lost in confidence and so forth. But as long as you've got 15 or even 10, you're still going to get pretty substantial demand relatively quickly, I would have thought. I think the big proviso is that second wave, because I think that'll take the wind out of any wind that's in people's sails. That'll probably certainly knock it out. But I'm really interested to see what happens. I think at medium property price level, I don't think the data is going to be that overwhelmingly strong. But I think it's arguably there's a risk there that will be quite patchy. So that is, there'll be areas that are very weak and then other areas that are much stronger. But anyway, who knows?
All right, well, that's probably about it today. We've taken up the full hour. I'd just like to thank everyone for joining. Obviously, just a reminder that we've got the second part to the webinar series Tuesday next week at the same time. So we'd certainly encourage you all to come along again. I'd like to thank, obviously, Jordan and Stuart for their contributions. It's been great. Hopefully, it's given you all some insights. You'll receive a copy of today's webinar later on this afternoon. And in that, you'll also receive some feedback forms. If you wouldn't mind completing those, that'll be very helpful for us. And if you've got any questions, if you'd like to speak to any one of us, please don't hesitate to get in contact with either of our respective companies. But thanks again. Thanks, guys.
Thanks, Jarrod. Thanks, Stuart.
Speak to you all soon. Take care.
Yeah. Bye.